be defined as the amount of money the owner of an asset will be paid after selling it, and any debts associated with the asset were paid off. Financial liabilities are obligations that a company owes the other parties, such as loans, bonds, and accounts payable. Moving on to characteristic. Financial equity represents the residual interest in the assets of an entity after deducting liabilities. Its characteristic includes ownership, voting rights, and potential for capital appreciation. Financial liabilities have several characteristics, including being legally binding obligations, requiring future payments of cash or other assets, and having a fixed or determinable amount of repayment. They can also carry interest or other financing charges, and their settlement can have a significant impact on company's financial position.
Assalamualaikum, my name is Muhammad Aziz. My page number is 074739. So today I will talk about distinguishing between equity and liabilities. Equity represents the ownership interest in an entity, while a liability represents an obligation the entity owes to another party. Equity is the residual interest in the assets of an entity after deducting liabilities. It represents the amount of assets that will be left over for the owners or shareholders if all liabilities were paid off. Liability, on the other hand, is a legal obligation that requires the entity to pay cash or other assets to another party. Liabilities can include accounts payables, loans, bonds, and other obligations. While equity represents the ownership interest in an entity, liabilities represent the claims that others have on the entity assets. Thank you, that's all from me.
Okay, next, we move to the problems arise related to the issue discussed in the article. Firstly, environmental expenses can lower firms' taxes and affect their borrowing decisions. When firms invest in environmental initiatives, they can reduce their taxable income and pay lower taxes. This means taxes play a significant role in how firms decide to borrow money. Additionally, these environmental expenses reduce the cash available to repay debts, limiting a firm's ability to take on more debt. Second, environmental liabilities increase the risk for businesses. Violations and poor environmental performance can result in unpredictable and substantial liabilities that impact firms' operation and financial performance. Stricter environmental regulations introduce more uncertainties for firms, such as fluctuating market demand, increased operating costs, potential litigation, and difficulties in obtaining external financing. This increased risk can lead to financial distress and bankruptcy, prompting firms to choose lower levels of debt to manage their risk. And finally, financial institutions consider environmental factors in lending decisions. Many banks now factor in social and environmental issues when providing loans. They are reluctant to lend to environmentally irresponsible firms and may charge higher interest rates to those with significant environmental concerns. Banks' lending decisions are influenced by various risks associated with environmentally problematic firms, including credit risk, litigation risk, and reputation risk. The lending practices of different banks may vary, with some placing more importance on a firm's environmental performance. This can make it harder for firms with environmental liabilities to access credit, especially from large and well-known banks.
Approaches might be used by the standard setter for this issue. The study examines environmental liabilities of firms using data from the EPA's Toxic Release Inventory (TRI) program. The program collects information on toxic chemicals released by thousands of facilities in the US. Will calculate the total waste produced by firms taking into account the toxicity of chemicals. Our main measure of environmental liabilities is the natural log of toxicity weighted production waste scale by total sales. Then, analyzing a large group of US firms from 1992 to 2013, we find that firms with higher environmental liabilities have lower financial leverage ratios. An increase in environmental liabilities leads to a 7.5% decrease in a debit to asset ratio. This impact is similar to the effect of the market to book ratio, a key determinant of capital structure. The negative relationship between environmental liabilities and financial leverage holds across different model specifications. Then, to address concern of causality, we perform tests using instrumental variables. We use the distance between EPA regional offices and firm facilities as well as the unemployment rate in the state where a facility operates. Additionally, we examine the expansion of the TRI program in 1997 as an external factor affecting environmental liabilities. Traded firms included the TRI program experienced a greater decrease in leverage compared to control group firms. While endogeneity remains a possible factor, our test support is causal effect of environmental liabilities on the leverage ratio. We also consider alternative measures of environmental liabilities. One measure captures the financial expenses firms incurred to comply with environmental regulations. It is based on the relationship between toxic waste and the cost of goods sold and capital expenditure. Another measure is obtained from the Enforcement and Compliance Historical Online ECHO database, providing information on costs imposed on firms for violating environmental regulations. Furthermore, we find that firms with higher environmental liabilities rely less on bank debit compared to total debit, even after considering differences in financial leverage. This suggests that banks may be more concerned about reputation and litigation risk when lending to these firms, as they are more easily identified compared to other lenders. In summary, our study shows that firms with greater environmental liabilities have lower financial leverage. We consider various measures of environmental liabilities, perform tests to address causality, and observe the role of bank debit in relation to environmental risk.
Okay, last but not least, conclusion. Critically commenting on the relationship between corporate environmental liabilities and capital structure, it is evident that these liabilities can significantly impact a company's financial position and decision making. Environmental liabilities pose a potential financial burden on companies. The costs associated with addressing environmental damage, pollution, or legal penalties can be substantial, requiring companies to allocate significant resources. This allocation of funds can affect the capital structure by increasing debt level or diluting equity through new issuance. Companies must carefully assess the financial implication and balance the need for environmental responsibility with their capital structure decision. In conclusion, corporate environmental liabilities have far-reaching implications for a company's capital structure. Companies must navigate the financial risks associated with these liabilities, maintain a balance between debt and equity financing, and address the changing landscape of environmental regulation. By doing so, companies can protect their financial stability, enhance their reputation, and contribute to a more sustainable future. That's all from us. Thank you.